Hello everyone, welcome to today's daily technical analysis lesson from ichimoku.co. Remember to visit ichimoku.co for further technical analysis lessons and also to view the daily free analysis and the more comprehensive analysis that's available for gold membership. In today's lesson we're going to look at how we determine the trend in what we call the second term time frame, and that's the higher time frame than the one that we covered previously, which was the first time frame, and that was looking at a chart on a bar to bar basis. Now we expand into a longer time frame, one that's normally called the medium term time frame or the second term time frame. So what's our definition for second term time frame analysis? How do we define an uptrend in the second term time frame? And we use the peaks and troughs of the swings in that first term time frame. Where they terminate is where we determine the peaks and troughs, and from that we determine an uptrend to be a series of higher peaks and higher troughs. So in a similar manner that we determined the first term time frame, which was on a bar to bar basis, if we had a bar or a candle making a higher high and a higher low, we have an uptrend in place. And in a similar manner, instead of using the bars, we use the swings, and we use where they terminate, and we use the peaks and troughs as the highs and the lows. So here's an example of an uptrend in place, and as always we start here on the left hand side and we have a trough, a peak, the market making a higher trough here, and as the market takes out that previous peak we have a higher peak made. Therefore we have an uptrend in place, because an uptrend is defined as a series of higher peaks and higher troughs. So once again, a trough, a peak, a higher trough and a higher peak as that previous peak is taken out. Here we see that point there, the bar that actually penetrates through that peak establishes that new higher peak, and therefore establishes that new higher term time frame in the second term time frame. And how do we define a downtrend in the second term time frame? Once again, we use the peaks and the troughs in a similar manner to how we defined the trend in the first term time frame, which was on a bar to bar basis or a candle to candle basis. Instead of using the highs and lows of the bars, we use the peaks and troughs of the swings in the trend. And here we have the market making a series of lower peaks and lower troughs, a peak, a trough, a lower peak and a lower trough. And it's at this point here, this bar that moves down through that previous trough, creating a lower trough, that establishes the second term time frame downtrend. So once again, a peak, a trough, a lower peak. Once we have that lower peak set up, then we're on the lookout for a new second time frame downtrend. The market taking out that previous trough establishes that series of lower peaks and lower troughs, and the market here goes on to establish further lower peaks and lower troughs, continuing that trend to the downside. Now, how do we determine that we have a break of trend? So if we're in an uptrend will end at the first bar that takes price action below a previous trough after it's established a lower peak. So if you think about it, what we have is the establishment of the opposite configuration of peaks and troughs. So here we have the market making a series of higher peaks and higher troughs. At this point here, we can say that we have an uptrend in place. The market continues to make a series of higher peaks and higher troughs. The market swings down as though it's going to make another one of these types of troughs. The buyers come into the market, establishing a new first time frame uptrend. A new first time frame downtrend is established, establishing the lower peak. So that peak there is lower than the previous, and once that trough there is taken out, we have establishment of a series of lower peaks and lower troughs. We have the opposite configuration of peaks and troughs in place, the market making a series of lower peaks and lower troughs, establishing a downtrend. And it's at that point there that we can say that the trend has officially changed. So once again, the market making a series of higher peaks and higher troughs. Here, once this lower peak is established, there is good potential for the market to potentially change trend. We take out that trough, and then once that trough is taken out, we can say that we have a peak, a trough, a lower peak and a lower trough in place, and therefore a downtrend is established, and that previous uptrend is no longer in existence. A new downtrend is in place. Also, if we have a downtrend is ended at the first bar to take price action above a peak, a previous peak, and it has to be the previous peak, and that's after the trending price action has made a higher trough, so the opposite configuration of peaks and troughs to the one that we've established with the downtrend. And looking here, the downtrend is in place. We have the market making a series of lower peaks and lower troughs. Here we have a peak, a trough, a lower peak, a lower trough. Once we take out that region there, that trough, we have a downtrend in place. The market establishes a peak, moves down, doesn't get down through the trough here, establishes a higher trough. As the market swings up, we have the setup for a change of trend to the upside, and once the market takes out that peak there, we have establishment of a new second time frame uptrend, and the previous downtrend is finished. And here we have the bar marked that takes out that previous peak. So once again, a peak, trough, lower peak, lower trough as the market trends down, establishment of another peak. The sellers aren't strong enough to take out the previous trough. The buyers come into the market, taking the market up above that previous peak. We have establishment of a series of higher peaks and higher troughs, and therefore an uptrend in place. And here we have a trough, a peak, a higher trough, and a higher peak as we take out that previous peak. Now, the important thing to remember here as well is that we believe that the previous trend remains in force unless we have an unambiguous break of the sequence of peaks and troughs. So in a similar way to with the first term time frame, we were looking at the highs and the lows. If we had, say, an outside day or an inside day that was ambiguous, we didn't have a configuration of the peaks or the highs and lows that fitted the model for determining the trend, so the previous trend remained in force. Similarly with the second term time frame, unless we have the opposite configuration of peaks and troughs, we can't say that the trend has changed and that the previous trend remains in force. Very, very important to technical analysis. Well, that concludes the daily lesson on the second term time frame trends. For further analysis and further lessons, please go to ichimoku.co. Consider becoming a gold member. You'll have access to more of the lessons and also access to the complete daily analysis.